Brian, what is your thesis here?
Well, first of all, we've been very, very positive about the company, and certainly going through the IPO process, very, very positive about it at the levels mooted at that time. And we actually did launch with a buy rating, and strongly recommended buying it at the levels at which were originally mooted. We've been very consistent in our valuation. The company's worth around $20 billion, the best knowledge that we can apply to the company. And that hasn't changed just because the stock trades up today.
So, Brian, at $45.30, that's where Twitter is right now. What are people getting wrong? What are they likely to be overly optimistic about relative to the way you look at the firm?
Well, you know, I'm going to guess that most people are probably still looking at the stock on a multiple of revenue basis, and they're post hoc justifying the value. That's a very common tactic. People say, the stock is trading this, can I justify it? Based on the momentum. And that's not the way I look at stocks. I look at stocks in a very fundamental way, comparable against other companies in a relevant universe. And let's put this into some context here. For the $30 billion or so, which Twitter is presently valued, you could buy the entirety of Discovery Communications. You could buy the entirety of Publicis and Omnicom Group. You could buy all of Yahoo. And some would argue that their 24% stake in Alibaba by itself is worth this much money. So the relative valuation alone is, should be your calling point.
What kind of a response are you getting since this downgrade just moments ago? Have investors reached out to you? What are they saying?
Well, Bloomberg's very fast. We just published this minutes ago.
But yeah, I agree. Our team is pretty good. But I'm saying investors in the market, has anyone responded saying, yes, I'm looking to sell here?
Oh, no. Like I said, literally, we just published minutes ago.
All right, then Bloomberg does kick it.
So, Brian, let's go back to your analysis of the company. Help us understand why, again, as you say, it should only be worth $30 a share as opposed to the 45 and change that it's trading at now. What do you compare it to? What are the appropriate multiples, and what are the comps?
Well, the first thing we do is we try to look at what the revenue potential is of the company based on our assessment of the business in the context of the broader digital advertising and advertising industries. And so we can get to about a $4 billion revenue number. Now, my understanding is relative to numbers that a lot of people are using, those are aggressive numbers for revenues. But I'm very comfortable with getting to around that range over a 4 or 5 year time horizon. We're very comfortable with about a 40% adjusted EBITDA margin, which all converts into cash basically because they don't pay taxes. So these are very positive aspects for the company. But then the question is, what kind of multiple do you put on a terminal basis based on relative growth rates, relative risks? And we can use Facebook and Google as really good proxies. We can see where the market is implicitly placing long-term growth expectations and long-term risk expectations. And we can say that, well, Twitter's a little bit riskier than Facebook. And we can say that it's going to grow faster than Facebook just by virtue of its smaller size. When you plug those relevant relative metrics in, there's a range that's plausible around a $30 number, but not $45.
How about the money, quickly, Brian, how about the money that Twitter raised, the $1.82 billion? Will that not come into play? Maybe it spends it in such a way that they grow faster.
Well, that's absolutely possible. In fact, I do expect them to do a lot of acquisitions. Now, it's hard to tell if some of that will be necessary to get to the $4 billion number.